Welcome back. Today we are going to talk about household size and income. Two very important factors in order to get this correct. Nothing worse than giving someone a tax credit, having them file their taxes next year and having yourself find out later that you screwed something up and the tax credit they got was too high or it wasn't correct, and now they're just not very happy with you. So it's very important that you learn who's included into the household and who's not, and whose income you should include and how much you include and what you don't include and things like that. So let's go over it. Very frank. Who's included? So when it comes down to the household size, it's based on your tax. So if you're filing taxes, let's say you're an individual, it would just be you. But let's say you're an individual but you have children and you claim your children, then you would also have them in your household size. If you and your wife have children, but maybe your wife's ex-husband claims the children and you're not claiming the children, you would not put them in your household size. It's very simple. So when I talk with someone, I just ask them, let me ask you, when you file your taxes, do you have any dependents? They're going to say yes or no. You can ask them if you think that they are filed as a dependent. Ask that too, because if someone is filed as a dependent, they're not qualified for a tax credit for themselves. That's part of the stipulation. You can't be claimed as a dependent and get a tax credit for yourself as an individual, right? So you want to make sure that they understand this, because there are people out there that may claim their disabled brother or their mom or their dad. So you want to ask, is there anyone else that you're claiming, a mom, a brother, whatever the case is? I always ask, because you'll uncover craziness. And sometimes you'll uncover policies, people that need help because they don't realize that you may do Medicare, and they'll say, well, I also claim my mom, and then you can say something about her insurance, and that open up another door for a different conversation. It does really well. See, what I find is when you become the marketplace master, or you can explain this insurance without any hesitation and just sound like you understand it, people will open doors for you for other things because you sound intelligent. The reality is, this is very easy. So who can't sound intelligent when you're talking about things that are straightforward? This is like A to Z. It's not difficult. Now, as far as the household income is concerned, it's pretty simple. I mean, they're going to say you're looking for your adjusted gross income, but that's a little bit confusing. So let's talk about it. If you're a W-2 employee, you're going to count your pre-tax dollar before taxes. That's what you're going to be counting. If you are 1099, a contractor, you're going to be counting your income after deductions. So that's where a lot of people that are self-employed have a huge benefit over people who work in this industry, because you can typically write off a lot of their business, or they can. I don't do any of that. I pretty much ask them, what do you file? Or if they don't know, see, my question is, if you work a job, I don't ask you how much you make a year. I'm going to ask you something like, do you get paid weekly or bi-weekly? How much is your check before taxes when you get it? And the reason why is because I find people don't know how much they make. So they might say 40, but then you do the calculations and it's 31, and that's a huge difference in the subsidy. So you really just, basically, if someone was to come after you put 40 in and put the real number in, they're going to give them a much better option. They may even be giving them a different plan because the cost share reduction may hit in between 40 and 31, and now your plan looks like trash, right? So I ask them the same questions. You get paid weekly or bi-weekly? How much is that check before taxes? I write that down. Now, if the person's married, even if that person's not getting coverage, you have to include everyone in the taxable household. Now, keep in mind, with these plans, they're going to if you're married, you must file jointly. There is no such thing as file separately unless you guys, the couple is actually separated or they're divorced. You gotta file joint. If they don't, the marketplace will not qualify them for a tax credit. There's a question that actually asks that, and you can't lie. Don't lie on the applications. Just don't do it. So that's another thing. Now, obviously, we're talking about all the people's income that are not filing taxes. Keep in mind, like I said before, if you're filing your own taxes, you can't be claimed as a dependent. So if me and my wife have a child who's 22 years old, and that 22-year-old is going to be filing their own taxes, they need to have their own plan based on their income. But if they're going to be, let's say, just working a part-time job and they're not going to be filing their own taxes, then you would include their taxes or their income into the family's income and put that in for the subsidy. Now, as far as the rest of the income, there are some times that you're going to talk with people and they're not going to have a job, or they're not going to be self-employed. They're going to be getting their income through maybe alimony. Alimony is it's very straightforward, but it's a little bit tricky, because with alimony, it's counted if the person has been receiving it before January 1st of 2019. If it's on that date of January 1st or after January 1st, 2019, it's not counted. Neither is child support. Neither nor. They're not going to be counted. So what is counted? Social Security, retirement. Now let's back up on Social Security. That would be regular Social Security and Social Security disability. It does not include Social Security supplemental. And it's not something, if you're not too sure what that means, if the person you're speaking to's Social Security check constantly changes, it's not the same number every month, it's supplemental income. And if that's what it is, it's not counted in the income guidelines for this particular plan. But what else is counted? Income from investments, rental, capital gains. There's a few more that may be counted. Let me see what else we have. So basically that's about it. Now what we're going to be able to do is, if you see this website right up here, that website is going to have a list of all of the different types of incomes that are counted and what's not counted. So if you have any questions, you might want to refer to the website. It's directly from healthcare.gov. It's going to break everything down that I just broke down to you. But if you have any questions, obviously, I'm sure you will, reach out. Until the next module, have a good day. Peace.